Autos and auto ancillaries together account for 49% of India's manufacturing sector. So today on It's the Economy, we are looking at the state of the auto sector. And I'm going to start with what Rajiv Bajaj told my colleague Parikshit Luthra just last week. Listen in.
For Bajaj Auto, where we hope to end this year, that is financial year 22, versus what we achieved in the financial year 19, which is the year just preceding COVID. Then in terms of total corporate sales, if we're going to finish at about 4.3 million vehicles now, this compares with a little over 5 million vehicles then. So that's a drop of 15%.
Okay. So the point is the sector has shrunk 15% compared to its own size 3 years ago. But Bajaj also told us that it is up 10% over last year. Right now, high raw material prices and chip shortages are hurting the supply side, while uncertainty of electric vehicle disruption plus slowdown in or a slowing economic recovery are hurting the demand side. To get more color on where the sector is headed in its recovery path and where it is headed in the year that will start on April 1st, I have with me two important players, Sunil Bora, Group CFO at Minda Industries, and Vinod Aggarwal, Managing Director and CEO, Volvo Eicher CV. Thank you very much, gentlemen, for joining me. Mr. Aggarwal, let me start with you, not the least because we are told that commercial vehicles is actually the positive side of the auto sector. The steel companies are saying that commercial vehicle demand is picking up. Just tell us, how does FY23 look at this point in time? Is demand or sales likely to be better? If yes, how much better than FY22?
Good morning, Lata. And definitely the CV sector is relatively better placed. And since the CV industry had dropped significantly in last 2 to 3 years, therefore the industry was at rock bottom. And as a result of that, and due to a lot of pent-up demand, this year we have seen very good recovery in the CV industry. And since the current levels also are still far away from the earlier peak levels, therefore we are expecting a good growth next year also, in spite of a lot of headwinds which are coming from inflation and some of the supply side challenges. So therefore overall we are positive for the CV industry for next year, even though there will be challenges.
Okay, but can you give us some number? I mean, I have till FY21 numbers for commercial vehicles, and at 5.56 lakhs in FY21, it was half of what it was in the peak of 2019. How are you likely to end to FY22?
Like if you look at the total CV sector, including the small commercial vehicles, in 18-19, that number was more than 11 lakhs, including exports. And now this year, we are expecting that it should be more than 8 lakhs.
Okay.
So it will be more than 19-20. And if you look at 19-20, the numbers were, you can say around 7.5.
Okay.
So this year you will be better than 19-20.
Okay.
And so it means you are pre-COVID levels.
No, but you're going from about 6 lakh in FY21 to about 8 lakh in FY22 is what you're saying.
Absolutely.
And 23 will be better.
Within that, the growth in the heavy trucks, heavy-duty trucks.
No, I'll come to the internals in a minute, but FY23 should be better than 8 lakhs.
Yeah, that's what currently it looks like.
Okay. Well, I'll come to you for margins and internals in a minute. Sunil Bora, can you, since you supply to both PVs and two-wheelers, can you tell us how the year is likely to end? How much better than last year and how much off-peak?
So, good morning, Lata. I think as Mr. Aggarwal also mentioned, for CV, definitely the year has been better than what it was pre-COVID. But if we see overall industry and the volume we are expecting, we serve customers in mostly all the segments, be it two-wheeler, be it passenger vehicles, be it off-roads, be it CV. So as of now, if we see, say, for example, the current ongoing or the current demand for the quarter, it's actually a mixed bag. So we all know the challenges which we have been facing in the two-wheeler segment because of the demand constraints. And from the PV side, while the demand remains robust, we have issues on our shoulders, on our back, which is on the semiconductor side. So vehicle booking for passenger cars specifically are ranging from few months, initial maybe 2-3 months to almost for some models going out almost like 8 to 10 months.
Ooh.
So the demand for PV segment actually remains robust, and we being a diversified player actually helps a lot. So if you see from a pre-COVID level, definitely two-wheeler is something which is on a lower side, but PV, we do expect things to normalize. Year on year also, there is a marginal improvement, and going forward, we expect this demand robustness in PV segment to continue, because the kind of indents we are getting for the next year, they are signing a good growth, signaling good growth from what we have seen in 21-22. So we remain quite optimistic.
Okay.
But as I said,
you think you will be able to beat, in the PV segment, the pre-COVID, you will beat FY19 levels?
not necessarily, Lata. Actually, it still will be a marginally lower than what peak we have seen, but maybe a year before what it was, we will do better than that. And maybe from peak, maybe a few percentage, single digit fall for next year or so. But again, things can show some surprise on a positive side, because as of now, the demand we are seeing is primarily.
So what you're saying is demand is good, but it will be a supply side issue.
Yes, you're right.
Okay. Well, coming back to you, Mr. Aggarwal, what about margins in the coming year? Commercial vehicle demand is robust, you said, or at least it will do better than the year that is just ending. How will margins pan out, given raw material prices?
Margins are continuing to be under tremendous pressure, and there are various reasons for that. One is that inflation itself is very high, and it is not, I think, possible to pass on the entire inflation. So that is number one challenge. Number two challenge is that our customers, like all the transporters, they are under tremendous pressure because of the oil prices, because of the significant increase in the fuel prices since last 1.5 years. I think their margins are under tremendous pressure because they have not been able to pass on the cost increases to their customers. As a result of that, they are also not willing to pay the price to OEMs for the trucks which they buy. Therefore, there is a lot of back pressure coming from the market, and then since there is a capacity situation is also not very good because the capacity is still available with the OEMs. Therefore, there is a lot of, you can say, competition, and discounts continue to increase. So as a result of that, margins are under tremendous pressure because of inflation, because of inability of our customers to absorb the cost increase.
Yeah, Mr. Aggarwal, I know it's a very unfair question to ask, but still, as you're better placed than anyone else, how much may production increase over last year? Because as Sunil is pointing out, you will have continued chip shortage problems. So how much may output be over FY22? And how much may margins suffer? I mean, will you give up 1 percentage point, 2 percentage points?
It will be very difficult to say that whether we will give up or we will absorb. Because as far as our own company, VECV is concerned, we don't run after the market shares. And beyond a point, we don't give the discount because we would like to, make the customers aware that what is the value if they go in for better products. What is the value that they will get from fuel efficiency? What is the value they will get from productivity? What is the value they will get from 100% connected trucks? But we are supplying trucks with very, very, you can say, very strong.
I am inviting you as an industry leader, sir. If you can, for the sector's sake, can margins take a 2 percentage point cut?
I will not be able to tell you how much cut it will come, but margins are under pressure. It is very difficult to say how much. Got that.
Sunil, the other point that industry players told me when I was preparing for this discussion is this problem of just-in-time. Until a few years back, just-in-time worked for auto companies. But now some players said they are at a loss as to how much will be demanded because of so many uncertainties of demand and supply. Is that a problem that you're sometimes worried about inventories and sometimes worried about shortages?
No, definitely, Lata, you're 100% right. Because of the lot of uncertainties which the industry has been facing for past couple of years, the average inventory number of days has gone up because people want to sort of play safe. And it's like a chicken and egg story or a vicious circle, because on one hand, you have a shortage issue for semiconductor, etc. On the other hand, people who are keeping inventory for 2 days, 3 days, 5 days, 10 days, now they have multifold inventory, maybe weeks. altogether. So while the supply side challenges remain, from inventory perspective, wherever things are available, people have tried to sort of increase their average holding period. So what has happened is, on one hand, you are trying to sort of play safe, keep enough so that you can. On the other hand, we have also increased the inventory with everyone. So definitely it has had an impact in terms of financial returns. And this is a challenge, I think, which we have to live with until the things normalize, maybe another few quarters.
Okay. Would you want to take a shot at how much margins may be under pressure, Sunil?
No, definitely margins are under pressure. And Lata, we have seen from our perspective, our margins year on year for last 2 quarters have been lower by almost 2 to 3%. And with the kind of pressure we are seeing, there is no sign of it being normalized. So in the near term, we do expect those kind of margins to continue.
Okay. No, that's the industry story as well. Actually, 4 to 5 percentage points was what industry people told me compared to peak times, say compared to 2019. Mr. Aggarwal, running out of time. So a final question to you. What is the single biggest silver lining that you see for FY23, and what may be your single biggest challenge?
Single biggest silver lining is that the industry is growing and there is a lot of pent-up replacement demand.
Okay.
So that is the biggest silver lining, and then the government is investing in infrastructure for the CV industry.
Okay.
And the biggest challenge is going to be inflation and availability of some of the parts like semiconductor shortage. So this is the biggest challenge. Okay. But overall, this challenge we are also meeting. I think the industry should be able to meet this challenge, and industry should still grow in spite of all these challenges.
Okay. Sunil, you get 10 seconds.
Yeah, I think the biggest silver lining for the industry is the kind of PLI scheme which has come out, and the numbers which we hear. People have, government was targeting investment of something like 42,000 crores over 5 years. And what industry has committed is more than 70,000 crore. So I think this capex cycle, once it triggers, it will create a multiplier effect. And we are quite optimistic that once industry grows, there are a lot of export-driven manufacturing comes into India. It will be very good for the entire sector.
Okay. Well, that's 2 silver linings, actually. The government's capex cycle as well as export growth, which even Rajiv Bajaj mentioned is the silver lining and has been. Thank you very much, Sunil and Mr. Aggarwal, for joining me in this conversation. Clearly, the government's capex cycle needs to continue. If it has to make space for higher food, fertilizer and fuel subsidies, then capex may get hurt to that extent. So a lot rides on the government's capex cycle and the multiplier effect. But of course, exports could be the wild card. That's it on this edition of It's the Economy, and it's also Curtains on Bazaar. Chartbusters coming up for you. It's a rather somber shade of red on the markets.